Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, Kevin, welcome to Pilot Money Guys. I think this is going to be number 110. Man, they're adding up. We're cranking them out. I think, because who knows? We might put out one in between. We don't know. It depends on what our producer tells us to do. Right?
Yeah, absolutely. Yeah, and I think we have about 40 good ones. So anyway, let's hope this is a good one.
That's right. Well, our man John, one of our American Airline pilots, complimented us on our last couple, even though they were boring. And I'll throw it out there. It's just good information. So that's our goal, is to get good information to folks out there that's actionable, that's useful. So that's what we're going to try to do today. Sometimes it's things that are a little nitty gritty. That's why we have you on here today, because we're going to cover today the OBBBA. OBBA?
Yeah,
Right?
it's OBBBA.
OBBBA.
The One Big Beautiful Bill Act. I'm just calling it the Triple B, though, Charlie.
Triple B,
Big
okay.
Beautiful Bill.
All right. Yeah. It's funny because I envision somebody saying, as in President Trump going, hey, this is going to be a big, beautiful bill. And then somebody says, we should name it the Big, Beautiful Bill. And then you would expect somebody else to go, no, that's not a good name. But that part didn't happen.
No. There's really only one vote that counts in that, Charlie.
That's right. Okay. We're not here to criticize the names, but it is quite funny. And we've had funny names before. So, okay. That's cool. So today we're going to talk about the One Big Beautiful Bill Act, recently passed, and how it impacts you. And you've got a great presentation put together. And we're going to talk about, first of all, the overview of what's happening here, the individual income tax changes, as in maybe the brackets we're going to talk about, any business tax provisions, new deductions. You and I were just talking about some charitable deductions that I think are a little significant, possibly. International and estate tax changes, or maybe no changes there, is of note. And then you're going to take us through some other things. But Kevin, what do you think, man? Are you excited?
Yeah, that's sort of everything, but we're just going to talk about the stuff that we think is really applicable for our airline and other professional pilots.
Yes.
And also, Charlie, there is a video on our YouTube channel that actually go through the presentation. So if you want to see visuals, if you're a visual learner, please check out our YouTube channel.
Absolutely. Leading Edge Financial Planning, YouTube. Kevin puts out especially a lot of good stuff there that is going to add in maybe some things we're talking about today. Also, this podcast will be on YouTube. So if you want to see Kevin's new camera and how handsome it makes him look, check that out, and it'll be there. So Kevin, I want to kick us off, man, because I think the biggest news of this big, beautiful tax bill is that the brackets did not change. And you and I have been doing our planning for the last couple of years, assuming the sunset provision is going to happen. And we've been looking at the projections, and it was a little scary at times, and even affected financial plans that we were running the numbers for going forward. So I think that's a huge win, but it may not feel like it.
Yeah, everybody loves a good sunset, Charlie, except when it comes to the taxes going back higher because of the sunset. So yeah, I mean, the best part of this tax bill is something that people will not really care about because it didn't happen. And what I mean by that is that if you had $5 million and I came out and said, hey, you now have $5 million. You're like, hey, I already had $5 million. That's not so exciting. But with this tax bill, what would have happened if it wasn't passed is the taxes would have gone back up again, as in before the TCJA, and tax rates would have gone anywhere, instead of 10%, they would have gone to 15, 25, 28, 33, 35, 39.6. But that didn't happen, Charlie. The tax rates stay exactly the same, which we think is a big win that will not feel good because we always compare it to last year, right?
Oh, absolutely. Yeah. This is a huge win. I was doing a plan the other day, and in our software, we have the ability to turn off the sunset provision, i.e., which is what we have now. And it makes a difference. You know, I mean, it's a positive thing to not have to revert back to those higher brackets like you talked about for the most part. So, but are there any details on the tax brackets that you want to cover, Kevin, or is it just like status quo that we say, and maybe they were inflation adjusted a little bit?
Well, in my reading, there was supposedly some more widening of the brackets, which is good, but I haven't seen it, Charlie. So
Okay.
so I don't know. That's written into some of the material we have, but just haven't seen it.
Okay.
I think the bigger part of the brackets is not the brackets themselves, it's just the phase outs when people start having to phase out of certain sweeteners that are in the bill. So I say that phase outs are not your friend because the only time you learn about a phase out, Charlie, is when do you hear about a phase out?
When you phase out.
When you phase out. Yeah. So when you make quote unquote too much money in air quotes, you phase out of certain things. And so you're like, yes, this is available in the tax bill. I'm sorry, you're
Yeah.
phased out.
Yeah.
And so it's a giveth and taketh away. So there's lots of these. And, to me, some of the biggest ones, if you don't mind, Charlie, I'll run through them.
Please, yeah.
The SALT deduction cap. It's, SALT is for sales.
Local tax.
Yeah, sorry. So, Charlie, do you know what the SALT deduction is all about?
I think it stands for state and local tax.
Yeah.
That's
And so
right.
which people care about these?
The people that pay, I think the people in Texas, they pay a lot of property taxes, and now they should be able to get to deduct that, I think.
Well, yeah, it used to be that we used to just talk about the high tax states, like
Yeah.
New York, Illinois, other northeastern states, Colorado, California. I don't know if Colorado is really considered a high tax state, but the reason why we have Colorado on the list now is because property taxes are going up because real estate is becoming so expensive. And you mentioned Texas. If you got two homes in Texas, you're going to be really happy that the SALT deduction has gone away. Even those in Arizona, there's not a high income tax there, but sometimes the property taxes are going up. So it's sales tax, it's property tax, it's income tax. Definitely can save tax in New York, California, unless what?
Unless you phase out.
Unless you phase out. The phase out starts at 500,000 and totally phased out at 600,000. We'll go through that again in a moment. But anyway, this comes under the purview of it must be nice to have that problem that you earn that kind of money. That's what others would say. But we know, Charlie, that people work really hard for the most part to get that kind of money. And then not getting the tax breaks is still frustrating. It's still a problem.
Very painful. Yeah, because you're scrapping and clawing at that point for any break you can find, and they've kind of excluded you. So, and I think the important thing there too, Kevin, is 500,000 AGI, which, not to get too confusing, but sometimes that's taxable income. So you would have to make significantly more than 500, but not in this case. 500,000, a little bit higher, you're going to be phased out. You know what I mean?
Yeah, yeah. And if you want to know all the different modified AGIs, forget about it. I can't remember them all. But this is going to be indexed for inflation, so it'll be 500,000, I think, this year, and then going up from there with the cost of living adjustment. So it won't always be 500. So we'll have to actually always plan for this and do some projections, Charlie.
Yeah. So Kevin, I'm going to do a super simple example, and you tell me, true, false, right, or wrong. If I'm a person in Texas and I heard Florida has high property tax as well, but let's say I'm a Texas resident, I pay $1,500 a month for property taxes. And so I can't do math fast enough in public here. So
18,000.
Thank you, Kevin. Thank you. So $18,000 is my annual property tax. Prior to this new bill, I only got to deduct 10,000 of that. Now I'll get to deduct the full 18,000 of my property taxes unless I'm phased out at $500,000 or more adjusted gross income. Did I get all that correct?
As long as you're itemizing, absolutely, Charlie. That's exactly correct.
Excellent. And then on top of that, I also not only get to deduct all of my property tax, 18,000 in this case, I get to deduct any state or sales. And now Texas doesn't have state, but
so sales tax for Texas.
Okay.
It comes into play.
So
Absolutely.
That could be significant, right? That could take a $10,000 deduction previous to this bill, and now it could be a $20,000 deduction depending on state, sales tax, et cetera.
You got it, and you know why this is so important now for captains. Captains that have a lot of time are working really hard to look at this.
Yeah, absolutely. So I think that's a big. I don't know, Kevin. Other than the status quo, maintaining the status quo income tax brackets, which was a huge deal, and the estate tax, which we'll get to in a minute, I think that's probably, to me, one of the other big items in this bill.
That's right. And we're gonna drop down in a second to all of these, Charlie, but the senior deduction, we heard even the day it was passed, I heard Social Security, no more tax on Social Security. I heard somebody on the news say it, and nope, that didn't happen. Social Security is still taxable, but if you're over 65 years of age, you do get, it goes up to $6,000 extra. So a super bonus for being older, we'll say. So anyway, that phases out at 175 single and then 250 married. So a lot of our clients, Charlie, or some of our clients might not get that extra senior deduction. No one's getting the Social Security one. Again, sorry to be the bearer of bad news, but that did not pass.
But that's pretty big deal. Potentially another $12,000 deduction if you're over 65. So.
Yeah, and Charlie, I'm all for any marginal increase in deductions, and this is one of those. So I think, again, sometimes we'll just have to play with the tax brackets if possible.
Excellent. All right. So we've got a few others in here, Kevin. I'm looking at the list that you made, and I see QBI, excess business loans, tip income, overtime pay, car loan, itemized AMT. Any of those for you that stick out to our audience? To me, it seems like not many in that list, but what do you think?
Yeah, so I think the QBI deduction can be huge. If you have a side hustle or your spouse does, that's a 20% reduction in tax when you have your own business. So that can be a big one. Hasn't changed at all. Tip income deduction, for people that are getting tips, this is fantastic. The AGI here, Charlie, I think 150 and 300, I think that's pretty high. Again, if the one in the couple is earning tips, then maybe you're going to phase out of that. The overtime pay, my brother-in-law, Raphael, is singing and dancing about this one, Charlie. So you make overtime money, and so it's $12,500 for overtime for singles, and it's $25,000 for married filing jointly. The same numbers for tip income as well. Maybe more people will be motivated to work overtime, Charlie. Right. So I think that'll be a big one. And, for kids of our clients, again, that could be something that they can look at to make extra money and not pay any tax on it.
Yeah. And I'm pretty sure I know the answer, but I'm just going to say it loud anyway. When you work extra in the airline, we don't call it overtime. Probably is no overtime. So that would be nice if you could categorize something, hey, I worked overtime, but I don't think it works that way in the airlines. But anyway, so you're right. I think spouses, maybe some children of our clients that might be able to take advantage of those things in the world of tips and overtime, and car loan interest seems to be kind of a minor thing. But I guess if you spend enough on your car at a high interest rate, which we don't recommend, and you make less than $200,000, married filing jointly, then maybe you can do a deduction there.
Yeah, well, I mean, this is an exciting one. And, this is where if you want to teach your child something, using tax policy to get people to spend, yes. I mean, that is pretty great, Charlie, that you could buy a new vehicle, take a loan, borrow, and then you can actually deduct $10,000 of interest per year. I think that's fantastic. Again, if you're a first officer, single, forget about it. If you're married, it's possible that you might be able to do it. Again, there is some idea here to maybe have your child buy the car in their own name if they're in their 20s. And of course, they have to get their own insurance, but that is kind of a strategy that I've been thinking about.
Yeah, probably a good idea for liability purposes anyway, to have that car in your child's name to keep you off the legal side of things. But this is one of those deals, Kevin, where you're right. The government, the tax policy experts script these things to influence behavior. So don't go out and buy a new car if you don't need one.
Yeah. Don't get a third car.
That's right. Excellent. All right. Anything else on those, Kevin, that you're thinking about?
Well, the only other phase out is for the people in the 37% bracket. We also work with physicians and other people that are in that 37% bracket, and you start to limit deductions there. So that's the final thing, Charlie, on phase outs.
All right. Excellent. The next thing I see here, we've got a standard deduction increase, which is always good and probably is kind of adjusted to inflation anyway, or is that part of the bill that was unique?
Yeah, it was increased a little. It's not meaningful, but it's actually $31,500 for a married filing jointly. Single is $15,750. But yeah, I mean, everybody likes a little more. Like I said, this is an incremental benefit.
Absolutely. And for those, just as a real quick remedial refresher, standard deduction is for those of you that do not itemize or deduct a lot of expenses. In other words, you get either to deduct all your itemized expenses or the standard deduction, whichever is higher. So that simplifies things as well. That was part of this as well, just to simplify those and give people a bigger deduction. So
that's right. That's right, Charlie. Now let's go to the SALT. Let's talk a little bit more about the SALT. It used to be 10,000 last year. Now it can go up to 40,000. Somebody asked me the question, I get $40,000 extra of deduction. I said, only if you paid the tax. So if you only have property tax for 4,000, you live in New York and your income is taxed and it's only 20,000 and you don't get all 40. But yeah, it's up to 40, which is really great. And we've seen some clients, Charlie, $35,000, $40,000 of tax and they only got to deduct 10. So to me, this is a huge deal for those people in the high tax states or the high property tax states. Can really be a benefit. And to make things really confusing, when you go over $500,000 of income, for every dollar you go over, it's a 30-cent reduction. So anyway, if you go over 500,000, we actually do have a chart here that shows going over 500,000 for, how much you'll deduct. And it goes all the way back down to 10,000 once you get over 600,000. But it's 30 cents for every dollar for those that really care.
Dang, yeah. I've got that in my head. I just calculated all that in my head. I'm good to go.
Absolutely.
Yeah, of course. But yeah, that's good though. I think that's a big deal, like we said earlier. Kevin, any other big deals as far as you're thinking about?
So Charlie, as far as bonus depreciation goes, thanks for asking. Bonus depreciation, this is really a big deal for clients that have businesses. And again, some of our pilots are real entrepreneurs. They have multiple businesses. So you used to be able to buy something new, a new tractor, new whatever, and you could only deduct 60% up front because bonus depreciation dropped over the years. Back up now to 100%. What do we always tell people, though, Charlie, about getting that 100% bonus deduction in a year?
There's two things. Don't buy a tractor just for the deduction, which I'm tempted to do at times. I know how it feels. And then secondly, if you sell that thing in the near future, you're going to get their little recapture nasty tax bill, right? Those are two things I think.
Right. About. Yeah. So you get to take the depreciation deduction over time. This jams it all up front.
Yeah.
This also can work for short-term rental properties, Airbnbs, et cetera. But it's never a benefit if it's not good for your economics. That's really the key message there.
Yeah, absolutely. That's good. That's good stuff. And they do these things to motivate us to buy stuff. So don't go out and think you're sticking it to the man because you bought a new tractor and got a deduction. That's what they want you to do.
So Charlie, let's talk about going to Oz.
Yeah.
So they've called these qualified opportunity zones. They've called them Oz because who doesn't like Oz, Wizard of Oz? Well, a lot of people don't like Wizard of Oz. They're afraid of the
flying monkeys.
Yeah, the flying monkeys. Yeah. But no, so these qualified opportunity zones, we looked a lot into these, Charlie, and we were very fearful to ever recommend them because it involves private real estate. But if you wanted to form your own partnership or something and do a qualified opportunity zone, we do have some clients that are heavy into real estate. This is something that could be done. And really, why do you do it, Charlie? Do you know?
Yeah.
Why would you do an opportunity
you and I
zone?
looked in this, and what I remember was there was a project in part of downtown Nashville that was maybe, how do we say, off the beaten path. It was not like right in the hot spot of downtown. It's going to be in an unattractive zone. That's the whole point, right? Is to develop those areas. And so then, from my memory, it allowed a person that had let's say they just sold a business and recognized a huge gain of several million.
Yeah.
And if you invested in a Oz opportunity zone, you could defer paying taxes on that gain from what I remember, or maybe not at all. But
that's right. That's right. Yeah, there were some real sweeteners in the original one. And now we have a little bit better understanding of how these work. So if you are going to get a big capital gain, I'd still think this would be something that you would want to check on.
Mm-hmm. Yeah, to me, Kevin, and because we're always thinking about people in situations, the one here that we didn't like too much was you take your gain that you just got from selling your business, you put it into an Oz, and the money is illiquid for a long time, is what I remember, which is not attractive.
That's exactly
or less attractive, I should say. So, Kevin, I think there's some stuff in there that motivate us to buy some more cars, I believe, maybe.
Yeah,
right?
yeah, absolutely. So again, you have the car interest deduction, Charlie, $10,000. That's a lot of money to be able to deduct. So I think that one's really good. Again, the phase outs are pretty low there. The other issue though that we know is coming is September 30th is the deadline. If you really want to get an EV, electric vehicle, they're going away after September 30th. So again, pretty good deduction. I think our friends in Colorado get a state deduction as well, at least they used to, unless that's gone away now. But you can still get that EV deduction through September 30th. There is a phase out once again, so check your income. But then there's a loophole around the phase out, and our man Jason Reagan came up with this, and we did check, and it actually is in the IRS code, which is always good for a loophole. But you can lease a car, and if you lease the car, supposedly the dealership can take the $5,000 credit and give you a better lease. So that's one of the phase outs. So don't buy one just to get the credit once again, but it is something that's available until September 30th. And if I can continue down the path of energy efficiency, we believe the solar, if you want to get solar, you can still get that up until the end of the year. So there is some really good credits there for solifying your house.
All right, nice. I've not heard that word before. I like it. Solifying.
I made it up.
And so September 30th, 2025, no more EV credits for going out and buying my Model 3 Tesla and getting this. I think it was a $7,000 credit, wasn't it? Was it credit or?
It's a credit, but I didn't remember it being that high, but it's very possible.
Yeah. And I think the phase out income there, we'll throw another number out, but it was $300,000 if I remember correctly.
$300,000 for married filing jointly. And you're right, it was $7,500 for the
$7,500, yeah. Yep. So that credit is quite a bit more significant than a deduction. So that's kind of amazing. But nonetheless, go buy your car before September 30th, 2025 if you want that credit. If you don't, if you want to deduct interest, go buy a new car, spend a lot of money on one made and assembled in America. Assembled in America.
Yes, thank you,
Thanks.
Charlie.
There we go.
Very important.
That's right. And lots of Mercedes are actually assembled in Alabama. So I think that should work. But anyway. All right. Anything else on cars, Kevin?
Well, I'm just thinking now, can you buy a EV Mercedes built in Alabama and take a loan? And anyway.
It's confusing.
Yeah.
Maybe deduct interest, but not get a credit. All right, let's see.
Yeah, so the government giveth and the government taketh away. So if you're a standard filer, Charlie, we had this a few years ago during COVID, where you didn't have to itemize to be able to take a charitable deduction. So now you have a permanent above the line deduction. I don't even know why they say that anymore. Who the hell knows what that means? Anyway, that just means you get an extra $1,000 on your standard deduction. It's on top. And for a married filing jointly couple, you can do $2,000. By giving away some money, you'll always get to deduct it. Over $2,000, you will not, obviously, unless you itemize. And if you itemize, you don't care about any of these sweeteners.
Yeah. So in other words, a quick interpretation, 2025, the standard deduction for, say, me and my wife, Lisa, $30,000. Right. If we have enough deductions, and let's say it goes up to $40,000, well, then we get to deduct $40,000. So we don't care about this new $2,000 joint charitable deduction thing. But if we only get the standard deduction of $30,000, I say only, that's a good amount of money.
Yeah. And
then we give away another $2,000, we're going to get credit for that now, which is great.
Yeah. 31.5 now, Charlie.
31.5.
Big, beautiful bill. Yep. So the taketh away part is that if you do itemize, you have to give away at least 0.5% before you get to start itemizing on the charity. So that's the taketh away part.
0.5%. So, help me understand that part, Kevin.
Yeah. So if you make AGI of $500,000 and you give away $2,499, you don't get to deduct that.
I got it. Okay, I see. So there's some good, bad in there. Again, if you're high income, bad. All right. Excellent. Let's see. You talked about some the energy and green credits. And
they're mostly all gone other than the two that we mentioned, Charlie.
Okay. All right. That's important to know as well, because people did a lot of stuff there. So I think the last thing we'll cover here, unless you have a couple other things, is just this estate tax change, which was That's another big deal that remains status quo that could have been really bad for some folks. But Kevin, what do you got on that?
Yeah, so this comes under the, again, umbrella of it must be a good problem to have, but the federal estate deduction was going from, I don't know what it was, maybe 12 million to 6 million, and then it would have been inflated. So anyway, so if you and your spouse had more than $12 million, you might have a problem in the future. Now it's 15 million per person. So now it's up to $30 million per couple. One of the things we've seen though, Charlie, is that there are states out there that do have state estate taxes. Washington is one that's around $2 million. So that really does affect our clients.
Yeah, absolutely. So Kevin, thanks for clarifying the federal estate, which is hard to say, tax non-change, which would have been a big deal. Again, those are always things. I think back in the day, several years ago, if you try to pass on more than a couple $1 million, the difference was taxed at a very high rate, federally speaking. And we don't need to go into that because it's not happening. So that's the good news. You can pass on $30 million, or you can give away $30 million at today's rates without paying any gift or estate taxes. So to get that
beautiful.
Right. All right.
Perfect.
I nailed it.
I got two more, Charlie.
Okay.
So one is, I don't know, maybe this is a thing. I didn't know it was the thing, but spaceports are classified, and they are classified similar to airports. So I'm not even sure I know what a spaceport is, but anyway, there's some benefit for spaceports. Yeah. And then the final one, I think to me, is one of the biggest changes in the tax bill. It has nothing to do with income. It has to do with 529s. The 529s are the biggest changes that I've seen in this tax bill other than income tax. Anyway, the 529 money can now be used for private schools, elementary, secondary schools. It can be used for college. As we know, you can turn it into a Roth. And now it appears that you can use this for any other type of education to better yourself, to credential yourself. So we are thinking that for flight school, it's very possible that you could use 529s for flight school. So please don't nail me to the cross on this one because I don't know for sure, but there's lots of examples of using it for CPAs and other licensing. So I think to become a pilot, that's all about licensing. Am I correct with that?
Absolutely. Yeah, you nailed it. That's been one of the big hangups, is not being able to use it for some of these schools that are sponsored by Delta has one, United, Southwest has their Destination 225. So I think that would be a game changer for people.
Yeah, absolutely. So anyway, I think that's the end. If you want to summarize, Charlie, what you think our pilots should know, let's start with first officers that maybe are newer, first officers and their income range and what they might be able to benefit from. First officers, they're going to have the higher standard deduction, which is going to be good because a lot of them are not itemizing. If they are itemizing, they get the SALT, they get the charitable deduction. Some of them might be able to buy a new car and borrow money and use the interest on the vehicle. And then also, if they have a second business, bonus depreciation 100% on that tractor. So I don't think any of our first officers are over 65, Charlie, so they're not going to get that senior deduction. But again, they might also have a spouse that's making overtime or tips or something like that they might benefit from. So I think, junior first officers, they're not going to have a lot of phase outs. That's really the key message there. More senior FOs and captains, Charlie, you're going to have to watch your phase out ranges. But again, taxes have not gone up at least. So that's something that we're very happy about. Yeah. And just watch the phase outs. And then our senior captains, Charlie, really the big concern is the SALT deductions. Absolutely. So that's just something to look at.
Yeah, absolutely. And, finally, big win just because it didn't revert back. It did not sunset. That's a big deal. We didn't think that was going to happen, and it did. So that's good news. And so we should celebrate that, as hard as it might be to celebrate something that didn't happen.
Yeah. Yay team.
So, that's right. Yay. Yeah. But Kevin, thanks for going through all that today. Super helpful. We appreciate our pilot tribe out there. And so if you want to get in touch with us, please feel free. Subscribe to our newsletter. You can email me or Kevin directly, kevin@leadingedgeplanning.com, charlie@leadingedgeplanning.com. We'd love for you to take the Pilot Wealth Index, which will be a hyperlink on this podcast, is wherever you're viewing the podcast. And we really appreciate your rating and reviewing it, sharing the podcast with others so we can help more of our pilot tribe out, just add value wherever we can. So thanks and have a great day.
Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out, give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.